Well, hello again. This is James Tarkenton, Senior Portfolio Manager at Townsend Asset Management. Last week, Gerald and I held another one of our webinars in which we spoke about how we select stocks and when to buy and sell them. So this is it was meant as a fireside chat. So Caleb fired questions at Gerald and I, and we shared taking the stage and talking about how we go about picking stocks and the activity of buying and selling. So want to share my computer with you and kind of walk through some of our thinking here. So how do we select stocks and how to make that buy or sell decision? Well, we are here to talk about stocks. It's important to know that you don't have to own stocks. You can get equity exposure through mutual funds or ETFs, which are going to be broadly diversified and be probably the most efficient way to go about getting equity exposure. And you don't even need to own equities. There's obviously bond and cash and or fixed income. But even if you were to buy individual equities, there are a number of strategies that that can be implemented for someone who's wanting that individual stock exposure, but maybe not their entire portfolio. That's something that we've referenced many times. It's Core and Explore, where you gain access through funds and ETFs to the general market exposure, and then almost like spokes on a wheel. Kind of surrounding those funds and ETF allocations, there's a pretty concentrated, collection of individual companies that you would add on to that the market exposure to try to generate a little bit more alpha or returns above the market. So, how do you begin? It is important to understand what a portfolio is, and that it's not just a collection of stocks. You are choosing to put individual positions in your portfolio for a reason. You want to be mindful of where you have your sector exposure. So this would be how the company is classified and what they do, and arguably what their exposures are. Back in 08 and 09. A lot of well-known value managers, own 7, 8, 9 banks in their portfolio, and they paid for it. So it's not just finding opportunities; it is, making sure where your exposures are, each exposure in any one place. But it's also, you don't need an extremely large number of companies to get mathematically relevant diversification. So we do lean a little bit more on the concentrated side. Ranging anywhere between 10 to 20 positions. This is kind of where the rubber meets the road, so to speak. Caleb referenced in his question that there are over 45,000 publicly traded securities on a global basis. How do you go about picking them? Well, one of the things I think differentiates us at Townsend, at least, is that as important it is what we're looking at, as important it is what we're not looking at. So we don't spend any time researching companies that we don't feel have the basic characteristics and business model structure that we're interested in. We're looking for good companies. We want to know what they do. We want to know what their value proposition is. Why should we expect the company to do what we expect it to do? And it all comes down to what the business does itself. So that's how we get started. We're formulating a thesis, a very specific reason why we're holding a company or holding a position in a company through a stock position. You don't want to be left at the whims of the market and essentially hoping to find someone who will simply just pay you more for something that you have. This investment thesis should be based off of kind of those key metrics and strategies that you've identified that justify not only the quality of the business, but then also the pricing opportunity. And there's different ways that you can filter and reduce the number of companies you're looking at. We run a screen here on a weekly basis, very high level. Basically, we run it on, the size of the company, the profitability of the company, and some evaluation metrics. And it's been spitting out about 160 companies. They're not all the same, but back in March, it was spitting out 400 companies. And that's just the starting point. You get that list of companies, and then you're rolling up your sleeves, one, figuring out why it's on the screen, and what's going to maybe change what its underlying story is or strategy is to really drive higher profitability. And as you cut down these lists, you're basically going to come up with a primary and secondary list. All of them are great companies, which is, again, the hardest part of this process, is identifying those. But it should be a pretty tight list. It shouldn't change that much. I think if anything is changing primary to secondary, it's mostly going to be price driven, meaning where you think the company's worth versus where the stock's trading. And there are a number of places to find all this information. I do want to mention that every public company, at least domestically, I know, has a section on the website called Investor Relations. This is the core avenue with which companies try to speak to their shareholders. You'll find every earnings release, press release, SEC filing requirements, and more importantly, company presentations. As management travels the country, well, I guess maybe used to travel the country, but still attending investor conferences. You've got senior management making a presentation on obviously what the company does, but then what the opportunity is. And really helpful are what are called analyst days. And so December 10th of this year, Walt Disney's having an investor day on its direct-to-consumer segment, which is the Disney Plus. But that'll be posted. You can listen to it live if if you're managing your calendar enough. The bottom line is that it takes work. I mean, you need to understand what these companies do and why you should be interested. And it takes a pretty high level of due diligence. So, assuming we've identified a good company, when do we buy it? What makes us pull the trigger? And there's obviously technical analysis where you're evaluating price movements. I don't think we particularly have any level of expertise there here at Townsend. We're so driven by just the bottom-up fundamental aspect of what the company does. But I do want to make I do think it's important to mention, a lot of people look for research resources and they get hung up in ratings and trying to quantify the safety or opportunity of the investment itself. And I would just caution against that. I think if you're going to be investing in the equity markets, your opinion is the only one that matters. You have to do the work yourself, and having somebody else tell you something's a buy or a sell really isn't going to lead into a successful experience. I think some of these research resources are great for coming up to speed on a company. What are investors worried about? What do they like about the company, et cetera? But again, I would caution against putting any weight or validity to any particular rating done by somebody else. And being in the equity markets, we've already assumed some level of risk. Certainly, equities would be, at least as measured by traditional ways, is more risky than maybe fixed income and certainly cash. But there has to be an understanding that if you're in the equity markets, you have accepted a level of risk that at times could be out of your control. So that's kind of why we're having this entire conversation. The only chance you have of being in control is knowing what you own. And so that's why we spend so much time on it. There's asset allocation strategies that can be used between asset classes to reduce risk. But I think it's important to mention that to us, the real risk is actually losing money. It's not a mathematical equation done by very smart people that spit out a number, and that's giving you some type of reference to how risky that particular asset is. So volatility, the amount and frequency with which a stock price moves around its benchmark is littered with flaws as far as the measurement of risk. But if you know what you know and the market's volatile, what that's going to do is give you the opportunity to buy more of a really great asset that you've identified that for whatever reason is bouncing around quite a bit, offering you those opportunities. We talked about diversification across sectors and within industries, and just making sure you're not doubling, tripling down on particular exposures. And there's nothing that can replace doing your homework and valuing the company. We spend a lot of time on discounted cash flows, but we do look at some more traditional metrics, whether it be price to earnings, price to free cash flow. Those, and the kind of the basic starting point is where is it trading on these metrics relative to recent history? Why is it different? Why will it be different? But those are all things that are needed, but it does take a frame of mind of understanding what exposure you're taking and the price you're willing to take those risks. And while everybody wants to know what to buy, I think it's certainly important to talk about what or when to sell. And that relationship really has no correlation to how long you've owned it. The best opportunities are going to be those that you've identified an opportunity. You've got a quote unquote margin of safety. If I were to use an example of we think the company's worth 100, the stock's trading at 97. Well, I found a great company, but that's I'm still taking equity risk, et cetera. And is that a big enough margin of safety for me? Versus say we think the company's worth 100 and it's trading at 80. Well, if you get that great opportunity and you're able to take a position, and the company continues to compound from an intrinsic value standpoint, similar with the stock price, and the stock price doesn't get ahead of the company or ahead of the story, there's absolutely no reason to sell. This really is a strategy where there shouldn't be a lot of turnover, because again, we're starting regularly with a very high quality list of companies. There are times though we'll make a mistake, and that usually is associated with your investment thesis doesn't work. So every time you're coming back to a company in your portfolio, you're evaluating that original investment thesis, and is what you expected to happen happening? If not, why? And do you need to take the capital off the table? I said this in the conference or the webinar. I'll say it again. If you're ever in a position where you're uttering the words, maybe it'll just go back up, that's a huge signal that it's time to exit. The other is times of exuberance where a company's stock can get way ahead of its fundamentals. And you found a great company, but there's absolutely no reason for you to hold it. And if everybody else wants to own it too, and they're offering you a price to exit that far exceeds what its current fundamentals or expected fundamentals would be, that's kind of imperative. It's a sign to go find one of those $80 stores. Every day I say that the portfolio has to prove itself. We think we've got a really great list of companies. Some certain day, it's evaluated that one is either from a risk or a return standpoint outweighs one that's in the portfolio. We'll switch it out. So that's kind of just, I think it is a differentiated way of thinking just about investing in stocks. Not only is finding the right process for you important, but it's having the conviction to stay with that process. A lot of people get in trouble by changing what they're trying to do because they feel what they've been doing isn't working. And it usually relates to user error versus machine error. But just wanted to have the opportunity to walk through how we think. I appreciate your time, and certainly if there's any questions that you may have, please give me a ring, and happy to talk about more about how we pick stocks. And please stay tuned for future webinars. I know we have a tax webinar coming up next month, and then I believe Gerald will be doing a webinar on investment themes. So thank you for your time. Please call if you have any questions.